Tuesday, August 3rd, 2021, Maneco 64, home of alternative economics and contrarian views. So today we're going to look at how a former Federal Reserve economic advisor is saying that the Federal Reserve could be losing control of runaway inflation. Yes, this is a mainstream economist. This is William Silber, and I've spoken about William Silber. I did a video on the 4th of July, actually, about a month ago. It was entitled, Former Fed Economic Advisor Says Gold and Silver Remain as Storehouses of Value. And I recommended his book, and I still do. It's a great book. I bought it probably about 6 weeks ago. Read it really quickly. I couldn't put it down. So it's called The Story of Silver, How the White Metal Shaped America and the Modern World. So here's the book. I couldn't put it down. How did I find out about this book? Well, on a YouTube channel called Coin Week. I recommend that as well for those of you who like coins, numismatics, silver and gold as well. And William Silber was on with them on June 21st, 2021, talking about his book. That's how I found out about the book. It's over an hour long interview, and I highly recommend it, where he talks about this book. And I did a video, of course, as I said, on the 4th of July, talking about the book, that I really enjoyed it. And he connected with me on LinkedIn. And yesterday, this is what I saw him write. And I hope he's okay with me going through this. He wants to come on the channel as well. He's got a new book coming out that hopefully we're going to talk about. But let's see what he said here yesterday on LinkedIn. And before I start, just to let you know that he was an advisor to the New York Fed. So here you go. William Silber is a senior advisor with Cornerstone Research and was a chaired professor at the Stern School of Business, New York University, most recently as the Marcus Nadler Professor of Finance and Economics, and before that as the Abram Gitlow Professor of Economics and Finance. He has served as senior economist with the President's Council of Economic Advisors and was a member of the Economic Advisory Panel of the Federal Reserve Bank of New York, and has published 8 books, including a college textbook, Principles of Money, Banking, and Financial Markets, with Lawrence Ritter and Gregory Adele. That has gone through 12 editions. So he knows what he's talking about, William Silber. So this is what he said yesterday. Runaway inflation is getting worse. The Consumer Price Index rose at a 9.2% annual rate in the 3 months ending June, on top of a 5.2% annual rate in the first quarter. These scary numbers come from month-to-month price increases in 2021, so they are not distorted by base effects of last year, and business leaders have acted. Jay Rambolt, Chief Financial Officer of WD-40 Company, said, "We've begun implementing price increases in many of our markets." CEO Hal Lawton of Tractor Supply Company added, "Where necessary, we are taking price increases to pass through some of the cost pressures that we cannot offset." After last week's Federal Reserve meeting, the committee released the message that inflation has risen, largely reflecting transitory factors. In earlier testimony, Fed Chair Powell said, "This is a shock going through the system associated with the reopening of the economy." And he says, "They might be right, but equally plausible is that blame for the current dangerous acceleration in inflation lies with spending by consumers flush with bulging bank accounts and by government deficit spending. These forces will not disappear. And here's the kicker. And they require the Federal Reserve to begin raising rates now to control runaway inflation. I agree with Mr. Silber, or Professor Silber there. The problem is the Fed, if they start raising rates now, the whole financial markets, the whole system, the banking system, I think will implode. The economy will go into a severe depression for many years to come. And I would say tapering is far from raising rates. Tapering is just decreasing the amount of QE they're doing, which is 120 billion a month right now. And they're thinking about lowering that QE maybe to 100 billion, let's say. But they're not going to be doing that until the end of next year or maybe even 2023. So if they came out now and started raising rates, it would be catastrophic for the system. And what's interesting is that Treasury yields yesterday, I tweeted out that something must be wrong out there because Treasury yields have really been dropping sharply. And yesterday in particular, we saw the 10-year yield go below 120. So what could be going on in the Treasury market? Well, I think it's two factors. There's a little bit of irrationality. I think a lot of the investors today, especially the young ones, they can't seem to think that we could have inflation. Inflation or CPI hasn't been really as bad as in the 70s for a long time. They think the Fed has it under control. I think it's a bit of that. It's a bit of as well that investors think the Fed will always come to the rescue. They won't allow interest rates or yields to rise by inflating even more, by doing more QE with money or reserves out of thin air. But there are big investors there starting to doubt the Fed's resolve against inflation. And yesterday we saw a huge announcement, and of course Treasury yields dropped quite a bit yesterday, but the announcement was this: U.S. Treasury yields ignore world's largest pension funds cut in U.S. bonds weight. GPIF's allocation for French, Italian, German, and UK bonds all increased slightly. It says U.S. 10-year Treasury yields lick Friday's wounds around. So let's go through this article. I think they took this from Bloomberg. It says U.S. 10-year Treasury yields lick Friday's wounds around 1.235%, down 5 basis points amid initial Asian session trading on Monday. The risk barometer remains pressured but fails to highlight Bloomberg's new news covering a record cut in the U.S. government bond and bills weights from 47% to 32% by Japan's government pension investment fund, the world's largest pension fund, during the 12 months ended in March. The news piece also mentioned Treasury Department data showed Japanese investors overall sold a net 24 billion of U.S. government bonds since the start of the Asian nation's current fiscal year on April 1st. Bloomberg added they offloaded 35 billion in the 12 months before that, the most in 3 years. Some of you might ask, why would they get out of treasuries that have a positive yield, nominal yield, and go into EU government bonds or UK government bonds? Well, I'll tell you why. Because if you look at the real yields, for example, and by real yields, I'm going to use here the German 10-year yield and the EU or the Eurozone core CPI. I'll give him the benefit of the doubt. The central bankers use the core CPI. So the core CPI in June, for example, year on year was 0.9%. So yeah, they're saying that core CPI went up less than 1% in June. But be as it may, let's take that number, 0.9, and add it to the German 10-year yield, which is negative 48 basis points. So you get negative 1.38. That's the real yield for German 10-year if you take the core CPI. So keep that in mind, about minus 1.4%, right? But if you look at the US, you look at the 10-year right now, it's at 118, and the core CPI in the US was 4.5% for June. So you subtract 4.5 minus, let's say, 1.2, that's a negative 3.3% return. So German government bonds are actually returning about 2% more in real terms. Yes, it's a negative return, but these pension funds, they are required by law and by rules to invest in government bonds. So they will go to the one that is giving them the least worse return. So that's why they're going into the EU bonds or Eurozone bonds. It doesn't seem to make sense, but when you look at the real yield, it does. So there you go. I think big investors are starting to take note of the inflation, of the fact that the Fed could be losing control of runaway inflation, as Mr. Silber says in his comment yesterday on LinkedIn. This is what he says at the conclusion of the book, which I thought was quite interesting. He says, the Soviet Union's experiment with communism challenged America for world domination for the better part of the 20th century before expiring like the worthless paper currency of the Weimar Republic. Central bankers remain on trial, and the uncertain verdict sustains the ancient role of gold and silver as storehouses of value in the new millennium. So I think that's becoming more and more relevant. I think the Fed is cornered. They're like damned if they raise rates and damned if they don't. So yeah, hold on to your metals, hold on to your tangible assets. Yes, and live within your means, because the cost of living is going to keep rising. And I think the CPI is going to keep rising, because we're going to see the increase in rentals come into the CPI really strongly. So with that, let's quickly look at where the markets are this morning. It's 8:30 a.m. London time. So we've got spot gold trading at 1810. It's down just over $3. We're still stuck in this range here. The range has gone up a little bit. Prior to last week, it was around 1790 to like 1810. Now it seems to be moving a little higher gradually, the range in gold. Silver is down about 10 cents at 25.30. Overnight range has been 25.45 to 25.22. Stock market didn't manage to finish higher yesterday. I think the Dow finished down about 100 points, which is really not much in terms of percentage. Right now, the Dow futures up 114. The NASDAQ future is up 29. S&P is up 12 points. The FTSE is up 12, just below 7,100. The currencies, sterling is up just under 0.2% at 139.07. The euro is unchanged at 118.77. Dollars down 0.1% versus the Japanese yen at 109.18. Dollars unchanged versus the yuan at 646.40. Aussie dollar is up 0.5%, just below 74 versus the dollar, and the dollar is unchanged versus the loonie or Canadian dollar at 125.09. WTI crude trading around 71, so we have come off since I spoke yesterday. Overnight though, it's unchanged. High grade copper is down 1/3% at 440.80. So I think copper got up to almost 450 recently, so it has come off a little bit here. And to finish off, the irrational 10-year yield is at 118. That's unchanged. I think yesterday we dropped as much as 6 basis points, which is a sign, in my opinion, that there's something wrong out there. And some investors, not all, the Japanese don't seem to be doing it, are flocking to the safe haven asset. That could be why. Who knows? We'll have to keep an eye on it. So if you enjoyed this video, make sure you hit the like button. Please share it far and wide. Think about subscribing to my channel if you haven't yet. And you can also follow me on Rumble, Twitter, Facebook, and all these other platforms below here. I wish you all a great day. Take care. Bye.